Hi, welcome everyone. Thank you so much for joining us. I'm Jen Rogers, and today we're talking about investing in real estate. Joining us is the Chief Investment Officer and Head of Funds Management Americas for Nuveen Real Estate, Shawn Lese. Shawn, thank you so much for being here. Excited to get started with you. I want to remind everybody that's come into the room that we want to hear from you. We've got chat going on. Please put questions in there. We have a lot to talk about, but hearing directly from all of you really helps inform our conversation. And we will try to get to as many questions as we can. We also have a poll question in there that you can take. We would love for everybody to go do that right now. It's about what real estate sector you think is going to be the best performer for the rest of the year. So that's a little bit for you guys to do out there. I'm going to get started with Shawn right now. And Shawn, I feel like we couldn't have planned this any better. There's so much happening in this space right now, especially following the Fed's decision and this pause that we're getting here. So, what is happening in real estate broadly right now, and why, in terms of valuations and the impact of interest rates that we've really all been living through this last year and a half? Set the landscape for us.
I'll do that, Jen. And by the way, thanks for having me. It's a pleasure to have an opportunity to speak with everybody here. Today is an interesting day because today represents 1 year since we've had the first interest rate rises. And that's really been sort of a point of demarcation for the performance of real estate, because what we had prior to June 15th, 2022, was we basically had real estate firing on all cylinders. And I'll talk about it from two perspectives. One perspective is operationally, how's it been doing from the ability to, lease up spaces, but also to increase rents, right? And prior to June 2022, it was on fire, right? No matter what sector you were looking at, you were able to put people in there and you were able to continue to increase rents. Now, I'll put a little caveat there. Offices were certainly challenged back then, and large format retail, so super regional malls, large malls, right? Million square foot malls were also operationally challenged, right? But then on the other hand, too, you've also got the capital market side, and that's really, is debt available? How much does that debt cost? And then what's the impact on the desire and ability to transact and buy real estate? And what is that doing for valuations? So both of those things are going to, have a pretty dramatic impact on when you talk about performance of real estate. How's it doing? Now, you kind of flash forward to today from, say, a year ago, and we have the operational side of real estate, again, aside from super regional malls and aside from a lot of the older vintage offices, right? The operational side is doing great. If you're talking about multifamily, it's doing pretty well. We've got a little bit of supply issues going on. Talking about industrial, you've got some good, strong strength going on there operationally. Same thing for a lot of the alternative real estate, and also for things like grocery anchored shopping center, neighborhood shopping centers. So that's a positive thing. But what has changed radically since a year ago is interest rates have risen dramatically. And that's impacted transaction volumes, and that's impacted valuations of real estate, right? And so we've definitely seen some declines kind of across the board on real estate, even in those asset classes where we're still seeing really strong rental growth, and you've got, kind of historically low vacancy rates.
I think people are interested in all of those sectors, and I do want to get to what might be working better right now. But I feel like we have to talk about offices and some of the caveats that you were mentioning. Just to, let's just address it right now, because offices really have been a different story, but it's been a story that's just grabbing headlines still. So I think, everybody is seeing these and wants to know, when is the worst going to be over in office, right? What is the timeline here that we're talking about? What are you hearing? What are you thinking?
Yeah, well, that's absolutely right. Those, when you see a lot of the headlines, like you'll see the odd kind of give back of super regional malls to the banks. That slowed down a lot, although, we've seen a couple of them in the last couple of days. But really the headline grabbers have been, office valuations down pretty dramatically. Now, what I would say about that is those headlines are very real, and there's a very significant decline in value of certain types of offices. And I would throw a couple of characteristics in there to define those types. Number one, older vintage office, right? So I'm talking kind of 2010 and older, and generally speaking, CBD. meaning in the central business district, right? So these are things that are also going to be much larger format offices. And what we're seeing here is basically, unless you've got offices that have, three important characteristics. Number one, they've got to have an element of focus on sustainability. So they've got to be a modern office, reduce your carbon footprint. That's very important for a lot of tenants, particularly tenants who describe, say, in their financial reports, what their carbon footprint is. Real estate is a huge component. That can be up to 40% of a company's carbon footprint. So to reduce that is a very good thing. The second thing is, we've all got kind of a return to work from COVID, huge focus on health and wellness. And so these are things like HVAC systems and filtration systems that can, are the most modern and can, pull out any of the kind of viruses that may be in the air, touchless entry systems, touchless doors, that sort of thing. And then the third thing is a really high level of amenitization, right? So we're trying to bring people back into the office. And in order to do that, you've got to make it a pleasant place to come and hang out. People don't want to need to be there. All right. So we're talking about a high degree of amenities. What does that mean? Great cafeterias, coffee, bars, golf simulators, gyms, right? These are the types of things where in the modern offices that we're seeing that generally have those offices continue to lease up, and they're actually getting some rents that are surprisingly high, right? So we're seeing tenants are willing to pay up for those kinds of characteristics. On the other hand, if it's an older vintage property, in order to make that property relevant and desirable by a tenant, you're going to have to invest a very substantial amount of money. And I mean, it could be up to, say, 50% of the value of the property. And that kind of cost on a very large format property where there's a lot of risk about whether people are going to be coming back and using it, right, is part of the reason why you're seeing what you're seeing on the office side. But, from an operational perspective, we are seeing it pretty much limited to offices and to those formats, those large format of retail where they're B's and C's, right?
All right, so we're going to leave those to the side for now. I'm starting to see a few questions in the chat. We're going to get over there. I want to encourage everyone to also answer the poll question about what you see being the best performer for the rest of the year. We're looking at apartments, healthcare, industrial, office, although you just heard Shawn talk now. So also retail and self-storage. So take the poll and we can address that. So let's broaden out here a little bit right now. And we have what we've learned about office, and there's some, retail also being impacted. Also what has happened on borrowing costs. So right now, what are the key investment things where you think there's opportunity that you've been focusing on in 2023?
Yeah, so certain of the asset classes have repriced pretty significantly and still have sort of a forward operational outlook that sound pretty positive, right? And so a couple of things in that category would certainly be self-storage. So I'm probably influencing
Yeah.
yeah. So
All the
anyway,
people that haven't answered now are going to get it right. Now,
yeah,
but go
exactly.
answer.
But no, things like self-storage, right? Pretty dramatic repricing that's gone on there, right? They're smaller format properties, very easy to get your hands around operationally and improve them. We're also seeing industrial having repriced pretty dramatically. So you can go back in and buy these things that were once maybe a 4 cap. But if you're also seeing that, you can buy them for cheaper and they still have very strong tailwinds from an operational side, those are things that are interesting, right? So, certain types of industrial interesting, self-storage, grocery anchored shopping centers I'd put into that category. I think when we get to multifamily, multifamily is always an investor favorite. Good diversified base. Everybody's aware of the fact that, there's a shortage of households in this country, depending upon who you ask, 3.5 million to 5.5 million. Right. We're seeing what's interesting about that is we are seeing a little bit of softness in some of the more desirable markets because there's been a tremendous amount of construction going on. I think in a lot of those markets, let's say like in Nashville, for example, you may have up to 14% of the existing stock of new deliveries coming online over the course of, say, the last year, maybe over the next 2 years. But I think that, basically developers do their research and they understand that there's a huge migration to that city. And I think you'll see some softness into that market, but you'll probably be able to absorb quickly those deliveries that are coming. And what's also positive there is that to develop is so expensive these days, between the cost of debt, between labor costs, the cost of construction materials, right? That you're not going to see a whole lot of brand new developments coming out of the ground for a while, right? Until we've absorbed all of the supply that's coming into the market, right? So those are areas where we think we've got fundamental operational strength, and where we've seen repricings. We think that can be a very interesting place to get into the market. Now, that's if you're an equity investor.
Mhm.
A lot of people access real estate through the debt side as well. And the one thing I can say is it's never been a better time to be a debt investor in real estate. Um, the returns that you can get there from a risk adjusted perspective are very, very strong, because not only have the base rates increased so dramatically, but you've also got spreads that have widened out depending upon the type of asset that you're lending on, between 50 basis points and maybe all the way up to 200 basis points. So that's the risk premium you're getting from it. But you're also got loans where they're lower LTVs and there's more structure, and so it's a very favorable time to access the market through just being a lender. And you can get what basically are, if you're a core investor, core real estate's always out there trying to deliver, we say between an 8 and a 10%, sort of over a cycle. Those are the types of returns that you can get from being a debt lender these days.
Are there still risks in that space as well, even if you're on the debt side?
If you're on the debt side, by all means, right? You've got to be very, very clear about the types of assets that you're going into. Like I would say that the capital availability for regional malls, right, is very, very suspect right now, unless it's one of the ones that is back up and running, and for certain that it's got footfall and it's got sales that are back up to where things used to be. Getting construction loans is challenging as well. It's going to be incredibly challenging to find loans in offices. So the types of debt that you probably want to lend against is maybe a brand new multifamily property that's getting close to being fully leased up and maybe coming off a construction loan. Maybe you want to lend against a portfolio of industrial assets or self-storage assets, for example.
That brings me back to the poll, which I want to check on right now. So the question, which real estate sector do you believe will be the best performer through the end of the year? Apartments at 37.9%, healthcare at 24.1%, industrial 10%. We've got office 3%, retail 20%. It's jumping out to me in here though is healthcare. That I was curious to talk about that a little bit, as well as something that we just really haven't touched on. You mentioned industrial a little bit, but what do you see in that sector? Is that there's some people that think that it's going to be a big performer? Would you agree with that?
Absolutely. No, I'm really happy to see that people, have focused in on that. That's one of our higher conviction investment classes as well. What's really interesting about healthcare related real estate, let's define what we mean by that. So these are things like medical office buildings, right? So you're receiving healthcare services outside of a hospital, right? And generally speaking, if you've got a medical office building where maybe they're doing hip replacement surgeries, or it's a building dedicated to providing cancer treatment, or maybe it's even just the place that you go to get very efficient X-rays and MRIs, right? These almost sort of industrialize healthcare services in a way where they can deliver them very cheaply. The thing we like about that is, we do have an aging population. Some people refer to it as the silver tsunami. The need for healthcare services is increasing. Healthcare services is already the largest industry in this country, and it's growing very rapidly, like 5-6% a year. And as a result, people need more and more healthcare services. That's a good thing. And then they need to get those delivered as efficiently as possible. And the way that you do that is through specialized treatment centers. And what we're seeing is that a lot of very high quality credit rated healthcare systems are looking to build new facilities to deliver these services, and that's a great way to get access to some real estate. What's also kind of nice is you've got a demand, and a sort of insatiable demand. You don't have the same kind of work from home risks that you've got with, say, traditional offices, right? Because you're going to do those services and you're going to go into the office building to deliver those. And then the other thing that you've got a tenant, generally speaking. If you've got a credit healthcare system behind you, that's a great formula, completely resilient in the face of any kind of economic downturn.
All right. Well, seems like that group of people is onto something there. I want to go to a question from the chat, from Luke. Okay, so I think this is kind of about like visibility of what's happening next, but also you got to look back a little. It asks, can you compare what reasonable cap rates were a few years ago versus now, with higher borrowing costs and higher risk-free rate of return? Also, is there a risk of continued earnings revisions? This is what I'm talking about in terms of the visibility and FFO. So, the free cash flow and the operating business here, in terms of decreases from public and or private REITs as old fixed rates roll over with new investments or balloon payments forcing refinancing.
Yeah, absolutely. Well, there's a couple of really great topics to be discussed in there. The first, I'm going to start from the back set of there, which is the refinancings, and that's when you're coming off of something with 3% debt, and then you've got to go back into something with 6% debt, right? That is going to absolutely hit your cash flow, and it depends on what is your rental growth going to look like. Can you keep up with that? Now, generally speaking, what's positive about the economic environment right now compared to, say, the GFC is that, I'm speaking broadly here, but whether you're taking a look at REITs or in the private markets, so public REITs, private REITs, the non-traded REITs, or in just the private markets in general, the level of debt is much lower than it was during the GFC, right? By 10-15%, and that's super important because it puts us in a much better position to both protect those debt investors, so they're you won't have the same degree of potential losses. But it also means that it's a little bit easier to finance at a much higher rate. Now, that having been said, there is going to be, for higher leveraged entities, when that debt comes due, right? There's a really tough decision that needs to be made of, gosh, do I do it now on a floating rate basis because maybe I'm coming off of a really low 3%, 3.5% fixed rate 10-year financing, or do I just go into something that's going to be maybe a 5-year fixed, and then you've got to lock that in for a longer time, whereas maybe the floating rate people think that it's going to be coming down over time. So the decisions that one has to make at this point around debt are going to have very complicated and definitely going to impact negatively performance of cash flow. The other component of the question, I think, related to the valuation side, and there's no question that valuations have changed and that cap rates have risen. Now, we have seen, it depends on what sector you're going to be looking at, but we've seen valuations, cap rates on industrial rise anywhere between, say, 100 and 150 basis points. And that was coming from a pretty low base. We've seen multifamily as one where we actually, there's a huge bid-ask spread that we think exists right now in the multifamily space. And so, I think if you're a seller of multifamily, you're a seller if you get something with a 4 in it, like 4.5, 4.75, and you're a buyer if you've got maybe 5.25 and 5.5. I'm speaking generally about like high quality, well-located multifamily. And that's way up from maybe where it was a 4% or so a year and a half ago, right? So there's no question that valuations have fallen, and I think that there's a risk of some further decreases as well. What I get a lot of hope from is we need to see the stability in the interest rate increases, right? So it was nice to see yesterday, kind of no increase. I think we got some signaling though that we could expect maybe 1 or 2 more. We need to see that stabilize before, I think, if you're a buyer of real estate, you can understand where can I think of this as like maybe my resting heart rate, and where do we go from here? And until we get that sort of visibility, I think you're going to see a very low degree of transaction volume, and ultimate price discovery is just not quite happening yet.
I mean, I know you don't have a magic ball, but still, how do you see this playing out? Like, what is when we've gotten a pause now. We're getting, we've got some tea leaves about what's going to happen. But when do you feel that you could get the all clear sign? Are we talking
Yeah.
next year or a year after? I mean, how long do these things tend to take?
Yeah, Jen, I think we're seeing situations now where you do have forced sellers because you have, say, non-trader REITs, or you have NCREIF Odyssey Fund, open-ended core funds that are designed for institutional investors, or you have public REITs that need to address financing concerns, and so they're going to need to pay down some of their debt. It's either, on a specific asset, or if they're unsecured, it's going to need to be on the enterprise overall. And so they're going to have to sell. They're going to have to sell some assets, and we see properties being dribbled out right now in the market. And what we're seeing is valuations are definitely off from what nobody's exceeding the valuations that we thought we might be able to get right at this point in time. And so what we're keeping a close eye on, really, to be honest with you, is the spreads, because really a lot of this comes back to when is debt available and how much does that debt cost. And when we start seeing a little bit more of a competitive debt market, that's a sign to us that maybe we've started bottoming out, right? So we're monitoring the spreads on the loans that we're making and waiting for them to sort of come back in and a little bit more of a competition to increase. And that's a good sign. Now that's kind of a general statement overall. The kind of the sales that are coming out where people are forced sellers right now, those are probably worth taking a look at, because the number of bidders on those are pretty small. And what we're actually also seeing too is a lot of times what you can do is, in the absence of any other kind of debt, you oftentimes can get seller financing at pretty attractive rates too. So, that sets you up pretty well for a decent return.
Shawn, thank you so much. This has been great. And I hope we can continue to talk, because now I want to talk on the other end of this. Now that you've told us what's going to happen, get to do that again. But I really appreciate it. Thank you, everybody, for doing the poll. Luke, great question. Really enjoy getting to spend some time with you. Shawn and Nuveen, thank you both so much.